Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at the latest earnings reports that just came out for two of the largest tech companies in the world, Microsoft and Google. Both companies beat analyst expectations for top-line revenue and profits. One company saw a significant spike in share price after the earnings, meanwhile the other saw a major pullback. So in this episode, we're going to go over both companies' earnings reports, take a look at how they performed over the last 3 months and their expectations going forward over the next quarter. And I'm also going to share my opinion on the earnings and whether or not I think both companies are at a buy or sell level at their current share price. And of course, if you're a follower of the channel, the largest position in my personal portfolio is Microsoft. I own 82 shares of the company with a current market value right around $26,000, and I'm up over $10,000 or 60% in this Microsoft position that I've held for the past few years. So overall, this earnings report means a lot to me as Microsoft is the top position in my portfolio, worth around 15% of the overall portfolio value. So before we jump into that Microsoft earnings report, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and on this channel we talk about the stock market, go over any major market news, and of course we also track the progress of my personal dividend growth portfolio as well. But of course, this episode, the focus is Google and Microsoft and their latest quarterly earnings. So if we jump over to the article from CNBC, Microsoft takes up on faster cloud growth and hopeful revenue forecast. Net income jumped 27% in the quarter in year-over-year growth. So overall, the company performed very well, posting EPS of $2.99 compared to analyst expectation of $2.65. As well, revenue surpassed expectations at $56.5 billion compared to $54.5 billion, so they beat by $2 billion on the top line. And going forward for the next quarter, the company's CFO projected $60 to $61.4 billion of top line sales next quarter, which implies again another great quarter of 15% annual revenue growth going forward over the next 3 months as well. So they had nice future expectations plus a very strong quarter. And after these earnings came out, the company saw a significant spike in share price. The company jumped up over 4% after this earnings was released. But from that high point, it has now since pulled back to the pre-earnings level. So if we jump over and take a look at the full earnings report Microsoft released, we can see that the revenue was up 13% year over year to that $56.5 billion number. Operating income just came in just shy of $27 billion, which saw significant growth up 25%. Net income of $22.3 billion was up 27%, and diluted EPS came in, like we saw, $2.99, up 27% year over year. And as a Microsoft shareholder, I absolutely love seeing these numbers. 27% EPS growth is absolutely phenomenal. And why we saw that bump up in share price initially after the earnings came out was because of the strong growth in their Microsoft Cloud Network, which came in at revenue of $31.8 billion, up 24% year over year as well. So Microsoft pretty much on all cylinders is performing very well. And if we take a look at this chart, it shows every division of the company and their latest quarterly performance and the revenue growth indicated in the number in the box. So we can see their Azure and Cloud Network, one of the most important areas of Microsoft's future growth, saw total quarterly revenue growth of 29%, and why it's significant is that the revenue growth actually surpassed how it grew in the previous 2 quarters. So it's actually growing at a faster rate than we've seen over the previous 6 months, which is a very good sign. This acceleration in revenue growth was also evident across multiple other divisions in the Microsoft business. Their dynamic products and cloud services, the Office 365 commercial products, and the consumer products, along with multiple other divisions, saw faster accelerating revenue in the latest quarter with no signs of slowing down. And if we take a look at their updated financial statements, this company is already a beast, but their statements even improved over the past 3 months. So if we take a look at the cash flow statement, this company generated over $30.5 billion of cash flow from their operating activities. And of course, as a dividend investor and a big shareholder in this company, I want to see the company's ability to generate cash, and we look at free cash flow in order to judge that metric. So if we take a look at net cash flow from operations at $30.5 billion in the last 3 months, and we subtract the $10 billion of capital asset additions, we get around $20.5 billion of net free cash flow. But of course, in my belief, I think share-based compensation should be subtracted from that number as well. So if we take away another $2.5 billion from the $20.5 of free cash flow, net free cash flow minus stock-based compensation is right around $18 billion in the quarter. So in the last 3 months, this company added over $18 billion of free cash flow into the business, which is absolutely phenomenal and very strong growth. And now if we move on to the balance sheet, Microsoft has always been in a very strong financial position, and that has not changed as of the latest quarter. Their total cash and cash equivalents come in at $144 billion compared to short-term debt at $125 billion. So their cash on hand today can cover all their obligations over the next 12 months. But this $124 billion is also overly inflated because short-term unearned revenue is included in this balance, and this is not an amount that Microsoft actually has to pay out. So for a lot of Microsoft's subscription services, if you purchase 1 year or 2 years upfront, Microsoft cannot recognize that revenue until they perform the service, and they actually receive the cash upfront, so the offsetting amount is unearned revenue. They have not performed that service because you prepaid for a year, so they haven't earned that revenue yet on the income statement. So it sits on the balance sheet as a liability, but this is actually not a cash outflow for the business. So even if you subtract this, Microsoft has double the cash on hand to cover all their actual cash outflows over the next 12 months, which is absolutely incredible. And Microsoft is one of only 2 companies that has a AAA credit rating and is actually higher than the US government in terms of their credit rating. Microsoft has a AAA rating. Johnson & Johnson is the only other company that maintains that AAA rating as well, and the US government got downgraded to a AA rating. So right now Microsoft is considered to be more credit worthy than the US government, which is absolutely incredible to even think about. And overall, in the latest quarter, they also do a great job of returning cash to the investors like myself. They returned $9.1 billion of cash to shareholders in the latest quarter. $3.6 billion of that was done by share buybacks, and $5.6 billion was done in the form of their quarterly dividend. So overall, the company has done a great job of not only buying back stock, but also growing their dividend payment at a double-digit rate each and every year. So my overall thoughts on the latest quarterly earnings is that Microsoft performed extremely well. We saw double-digit revenue growth, fast EPS growth, their cloud revenue is accelerating at a faster rate. Across multiple different divisions, they're seeing increased revenue growth as well. The company returned a ton of cash to investors, and overall, I thought it was a very solid quarter for the business. I don't understand why it's selling down since it peaked, but I will continue to monitor the share price. If it falls even further, I may continue to add more shares to my position, but overall, this remains the top position in my portfolio, a very long-term hold, and I do believe I'll be a Microsoft shareholder over the next decade to come. So this was the first big tech company's earnings we had to take a look at. And now if we jump over to the second major company, we have Alphabet or Google, whose share saw a significant pullback after their earnings was released, even though the company reported revenue growth of 11% year over year, and they topped analyst expectations. So if we take a look, EPS came in at $1.55, beating by 10 cents over the analyst expectation. And revenue came in at $76.7 billion, again beating the $76 billion estimate. So although the company beat on both top and bottom line expectations, the share price has seen a major pullback. From where it was trading pre-earnings, it is now down over 11% at this current share price. And my personal opinion on this situation is that this is a major overreaction from the market. Google is not worth 10% less than where it was last week. This company's earnings were still very strong, and the reason we saw the significant decline in share price was due to the performance of their cloud unit. We all know cloud and cloud revenue growth is a major area of concern for some of the top companies in the world. And with Amazon and Microsoft leading the cloud industry, Google currently sits in the 3rd position. So after this latest quarter, many investors were focused on the Google Cloud business and that revenue acceleration in order to judge the future potential earnings of the cloud business overall. So right now, Google sits in 3rd place behind Azure and Amazon, and because it is the 3rd place position, you are hoping for faster revenue growth than the competitors because it is a smaller business, and of course, hypothetically, smaller businesses have the ability to grow at a faster percentage growth rate just because of the size of their operations. So in the latest quarter, the cloud business still grew 22% year over year, and it went from generating operating losses to actually bringing in operating profits of $266 million in the latest 3 months. So although this division isn't performing to the expectations of analysts and investors, I still think overall this is very strong growth. I will enjoy 22% revenue growth. Of course, we would prefer to be higher. Everyone wants higher growth, but I think the market is significantly overreacting to this earnings report, and I do not believe Google is worth 11% less today than where it was just 3 days ago. So if you're interested in Google, if you have this company on your watch list, I think it's getting more and more attractive. I do not own the stock at all. I do not buy companies who do not pay out a dividend, even though they may be great businesses. It's just one of the rules I have for my portfolio. And I think Google at this current level is becoming very, very attractive. And if we take a look overall at the latest earnings report, we could see revenue came in at $76.7 billion, up 11% year over year. Operating income came in at $21.3 billion, which is up 28%. And overall, if we take a look division by division, Google Search and Other saw a nice increase in sales. YouTube ads saw a nice pickup and actually saw accelerating revenue growth compared to prior periods. The Google network saw a minimal decline in revenue, but overall Google advertising sales topped over $59.6 billion in the latest quarter. We can see the Google Cloud revenue also saw that acceleration from $6.8 billion up to $8.4. And if we take a look at this company's financial statements, again, incredible numbers. Taking a look at the cash flow statement, this column right here represents the latest quarter. Their cash provided from operating activity comes in at $30.6 billion. They purchased $8 billion of capital assets or property, plant, and equipment. So if we subtract that out, that leaves them with $22.6 billion of net free cash flow. And of course, like I mentioned with Microsoft, I prefer to subtract out stock-based compensation. So if we take out another $5.7 billion of stock-based comp in the quarter, that leaves around $17 billion of overall net free cash flow for the business, similar to Microsoft's number in the latest quarter. Again, very strong cash generation from this tech giant. And if we go over the balance sheet, this company, similar to Microsoft, is an absolute beast with an incredible financial position and absolutely no liquidity or long-term debt risk whatsoever. Their total cash and cash equivalents come in at $113 billion. But if we take a look at the total liability section of the balance sheet, the total debt, short and long-term for the business, comes in at only $109 billion. Meaning the company with the cash on hand today can pay off every single dollar of future liabilities and still have a couple $2 billion in the bank. That just means this company overall has pretty much zero risk of any liquidity or financial risk going forward anytime soon. So again, another beast of a business that may be a nice addition to your portfolio. So overall, we're going to wrap up the video. In this episode, we discussed the latest quarterly earnings report from both Microsoft and Google. As an investor in Microsoft, I thought the company performed very well. I'm going to continue to hold and may buy more if the share price declined. And as a prospective owner of Google, I think the 11% decline in share price was absolutely ridiculous. I understand why it fell, but I don't think that significant decline was warranted. I still think this is a very strong business. I think their cloud business will continue to accelerate over the long term. And overall, that's just my personal opinion on how these latest companies performed. Let me know your thoughts down in the comments down below. Thank you for watching all the way to the end, and I will see you in the next video.